Joining me now with more is Justin Wolfers. He's a professor of economics and public policy at the University of Michigan. Thank you for being here with us. And look, as we know, the Federal Reserve, right, is an independent entity. It's independent from the executive branch. So from an economist's perspective, let's just talk about the precedent that is being set right now with this announcement from the president.
This is effectively the president making our independent central bank no longer independent. If he can just fire any Fed governors because some other bloke that he appointed has accused them of something, not found them guilty of anything, then that means you're going to fire any Fed governor at any time. If that's the case, then effectively monetary policy will be run out of the White House. If that's the case, that means we no longer have an independent Fed. We'd be looking at a MAGA Fed. Do you want monetary policy set in the best interests of the American people? That's what we have right now. That's what Congress has required. Or would we move towards having monetary policy run in the president's best political interests? That's the possibility, and it could be very painful for all of us.
They just had her statement from her lawyer up there on the screen. What is your response there to her statement? Essentially, the idea here that she's not going anywhere without a fight.
I think it's absolutely essential. There are moments in an economist's life when you stand up for something because you think it really matters for the American people. She was appointed to help run monetary policy. She was appointed using laws that Congress passed. That's her job. The president can only remove her for cause, hasn't shown such cause, and she needs to keep doing her job, not for her, and not for any particular view about what should happen to interest rates, but to preserve the integrity of this institution that does such a great job in helping balance the ups and downs of the business cycle. They don't get it perfect, but I tell you, they get it better than than the White House, any White House would ever do, because it insulates them from politics.
Well, and we know that there wasn't a consensus the last time that these interest rates were discussed, though. In your opinion, as an economist, does the president have a point to his argument that he does want these interest rates lowered?
No, so any sense in which there's disagreement among professional economists is somewhat illusory. So yes, we economists argue. We argue should interest rates be a quarter percentage point higher, a quarter of a percentage point lower, but we're all basically in the same ballpark. Whereas the president has called for cutting interest rates to a level so low, you would only call for them that low if we're in the midst of a deep recession. And if we're not, that would cause yet another painful inflation, particularly with tariffs coming. So yes, we quibble amongst ourselves, but we all agree interest rates should be around about 3 or 4 or 5%. It's the president who's all alone by himself suggesting something very extreme and potentially very dangerous.
Well, but wasn't there some people on the Fed board, though, that thought maybe they should consider lowering the interest rates, but maybe not to the point that the president wanted them at?
Yeah, so this is potato. Look, you might say 4.25, I'll say 4, but can we just agree that both of those are pretty darn similar? Instead, the president's suggesting that we should have interest rates down at 1%, which is the sort of rate that not too many years ago we would have thought is unheard of. It's the sort of approach to monetary policy that other countries have tried. When a strongman populist comes to power and demands low interest rates because all he cares about is goosing the economy before the next election, then what you get is inflation. And we've seen this play out time and again, whether it's Turkey or Argentina, and resisting those pressures is what maintains a useful and stable economy for the rest of us.
What kind of position does it put the financial markets in if there's essentially always a concern that the president may weigh in and do something like this, and you watch the markets react?
On edge. They're on edge because an important pillar of the global financial system, which has been the independence and stability of the Fed, is currently under threat. And here's the funny thing, even if the president doesn't follow through, he ends up hurting America, because what happens is financial markets look forward. They're now building in a risk that our country will no longer have an independent central bank. And if that's the case, then they have to build in a risk that inflation will be higher. And if that's the case, then they'll only be willing to lend us money at higher long-term interest rates. And so the irony here is the president, in his desire to cut interest rates, has followed a path that's actually leading to higher long-term interest rates, which are the interest rates that matter for starting a business, paying your mortgage, and for the rest of the economy.
Well, and we know that those are a lot of the people that voted for him and that want him in office. It sounds like the president's ready for a legal fight. It sounds like she's ready for a legal fight as well. What do you anticipate of that? And in the meantime, how are the American people supposed to analyze all of this while they're trying to look at their own finances?
Great. So let's take that last bit first because it's the most important. What really determines which countries are rich and which are successful, like the United States, and which are poor, say like Argentina, is the quality of their economic institutions. And so as we undermine these institutions, whether it's national statisticians that tell the truth, whether it's an independent Fed, whether it's budgetary authorities that make sensible decisions, those are the things that make countries rich. And so if the president were to start to undermine these, and he has in a range of domains, then that is not going to cause a recession tomorrow, but it will undermine the economy in such a way that your kids will be materially worse off than they might otherwise be. There's a recent calculation that shows that the typical populist leader ends up lowering the average income in a country by about 15%, but it happens gradually over a decade or 2 decades. In the United States, that would mean $13,000 per American. And that's a loss that you would occur every year for the rest of your life. So if you live a long and healthy life, the stakes for you, the viewers at home, are actually $1 million.
All right, Justin Wolfers, thank you for your analysis. We appreciate you being here with us.